My name is Mike DeBliss. I'm an attorney specializing in U.S. international tax compliance. The topic of this podcast is online poker accounts and the FBAR. I think a good way to back our way into this is to define what an FBAR is, and starting off with what it stands for. It's an acronym that stands for Foreign Bank Account Report. It is a tool that's used by the U.S. government to identify people who may be using foreign financial accounts for nefarious things and to break U.S. law. The information that is carried on an FBAR can be used to identify or trace funds used for illegal purposes or to identify unreported income maintained or generated abroad. The agency that basically issues the FBAR is FinCEN. It's the Financial Crimes and Enforcement Network. It is enforced, however, by the IRS. What's interesting about the FBAR is that it's not really anything new. It's a product of the Bank Secrecy Act that was signed into law back in the 70s. It did not start to be enforced, the FBAR that is, until after 9/11 for reasons that you might imagine. When the U.S. government realized that there was a great amount of terrorist money that was flowing through our banking system, they recognized that it was critical to identify these illegal sources. And they also recognized that the FBAR was an extremely valuable tool for exactly that purpose. Contrary to popular belief, the FBAR is not technically required by the tax code. Instead, it's a creature of the Bank Secrecy Act, as we've already discussed. Today, the IRS has breathed new life into the FBAR as a tax enforcement and revenue-raising tool. The IRS has been administering and enforcing the FBAR since 2003. The penalties that accompany an FBAR are staggering, and as some tax attorneys like to put it, it has helped to replenish the coffers of the Treasury by amounts that are unimaginable. So the FBAR rule is very straightforward. However, every term here has a very precise legal meaning, and this is not the podcast where I'm going to define every term for you. I just want to give you an overview of the rules so you have a general understanding of it. A U.S. person has to file an FBAR if that person has a financial interest in or signature authority over any financial accounts outside the U.S. and the aggregate maximum value of the account exceeds $10,000 in U.S. currency at any time during the calendar year. So we can boil the rule down to 6 key elements. First is U.S. person. Second, financial interest in or signature authority over. Third, any financial account outside of the U.S. Fourth, aggregate maximum value of accounts. Fifth, exceeds $10,000 U.S. Sixth, at any time during the calendar year. So what could happen is that even if for 1 second your bank account hovered over $10,000 in U.S. currency, let's say it was $10,000.05 for maybe 1 day in the tax year, that would trigger what's called an FBAR. Again, this has to be a foreign bank account that you're maintaining, i.e. one that's outside of the U.S., but that would trigger the filing of an FBAR. Because foreign bank accounts generally have currency in the foreign exchange, What's used for the conversion rate is the conversion rate that's in effect as of the last day of the tax year. So if you're dealing with yen, for example, you would simply use the currency exchange rate of yen to U.S. currency on December 31st of that year. And again, if it exceeds the 10,000 U.S. threshold, even by as little as 1 penny, then that triggers what's called an FBAR that must be filed. Now, I want to jump into poker accounts because this issue of online poker accounts is perplexing. And the issue is whether an online poker account has to be reported on an FBAR. You might not realize it, but when you are in a virtual world, an online world, and you are, you're involved in some type of online gambling, the account or the place where you've parked your money to use to play poker or some other online game might actually fit the definition of a foreign bank account. And if that's the case, it might trigger a requirement to file an FBAR. This, of course, is not something that people are aware of or even looking at. And so I hope that this will shed a little bit of light on the issue. It's a very gray area these days, but the Ninth Circuit Court of Appeals has actually weighed in. The Ninth Circuit Court of Appeals held that a taxpayer's accounts with 2 foreign-based online poker sites were not bank accounts that a taxpayer must report on an FBAR. Essentially, the Ninth Circuit overturned the decision of the district court judge who held that the 2 foreign-based online poker sites were bank accounts. However, there are a few caveats here. So I'm going to give you some facts of the case. In this case, John Hum, I believe that's how his name is pronounced, it's H-O-M. He gambled online through internet accounts with PokerStars.com and PartyPoker.com, and he used an account at FirePay.com, an online financial organization that received, held, and paid funds on behalf of its customers to fund the other 2 accounts. So FirePay was basically an online financial organization that was used to fund PokerStars and PartyPoker.com. At some points in both 06 and 07, the aggregate amount of John's funds in his FirePay, PokerStars, and PartyPoker accounts exceeded or went over $10,000 in U.S. currency. Right there, that should trigger some bells and whistles in your mind as we were talking earlier about how the threshold for triggering the FBAR is $10,000 in U.S. currency at any point during the tax year. After conducting an FBAR exam of John for 06 and 07, the IRS assessed penalties against him for failing to file FBARs for his interest in his FirePay, PokerStars, and PartyPoker accounts for tax year 2006, and a penalty for failing to file an FBAR for PokerStars for 2007. When John failed to pay the penalties, the IRS turned around and sued him in federal court. So what were the IRS's arguments? They claimed that FirePay, PokerStars, and PartyPoker were all financial institutions because they functioned as commercial banks. The district court agreed, and it reasoned that John opened accounts with all 3 entities. He controlled access to the accounts. He deposited money into the accounts, withdrew or transferred money from the accounts to other entities at will and on demand, and could carry a balance on the accounts. So essentially, the district court judge found that FirePay, PokerStars, and PartyPoker were the functional equivalent of a financial institution. And it passed the duck test. If it looks like a duck, walks like a duck, and quacks like a duck, it must be a duck. The court also found that because all 3 entities were licensed and regulated in foreign countries, they were foreign financial institutions. So what did all of this mean for John? The court held that John's online accounts with these online poker accounts should have been reported on an FBAR. Now, that means that the court essentially was rubber stamping the penalty, the exorbitant penalty that the IRS assessed against him. Naturally, John did not like that. So he appealed the district court's decision to the Ninth Circuit Court of Appeals in California. What did the Ninth Circuit do? It affirmed, meaning it approved the district court's decision with respect to the FirePay account. All right, and I'm being very careful with my words here because the Ninth Circuit affirmed the district court's decision when it came to the FirePay account, and it was because FirePay qualified as a foreign financial institution. However, and this is where it gets a little bit gray, the court reversed the decision when it came to the PokerStars and Party Poker accounts. And their reasoning, the Ninth Circuit's reasoning there, was that those accounts, PokerStars and Party Poker, did not fall within the definition of a bank, securities, or other financial account. So what the Ninth Circuit did was basically split the baby here. They agreed with the district court judge when it came to the FirePay account that it qualified as a foreign financial institution. However, the Ninth Circuit reversed the district court judge's decision with respect to PokerStars and Party Poker. So the taxpayer, John, actually had a partial victory. He won when it came to PokerStars and Party Poker because the court reasoned that those accounts didn't fall within the definition of a bank, securities, or other financial account for purposes of triggering an FBAR. But he lost with respect to FirePay because the court held that FirePay qualified as a foreign financial institution and thereby should have been reported on an FBAR. The court reasoned that the FirePay account fell within the definition of a financial institution for purposes of FBAR filing because FirePay was a money transmitter under a very special section of the U.S. Code. If you're interested, the section is 5312A2R, as in reindeer. The court viewed FirePay as an intermediary, essentially, between John's Wells Fargo account and his online poker accounts. John could carry a balance in his FirePay account. He could transfer his FirePay funds to either his Wells Fargo account or his online poker accounts. FirePay also charged fees to transfer funds. So FirePay acted as a licensed sender of money or any other person who engages as a business in the transmission of funds, and therefore was no different than a financial institution. The court held FirePay was a foreign bank because it was located and regulated by the United Kingdom. Now, in contrast, the court held that John's PokerStars and Party Poker accounts were not reportable because, again, they didn't fall within the definition of a bank, securities, or other financial account. The IRS, one can almost predict what the IRS's argument was here, but it's worth restating. The IRS argued that these two entities were functioning like banks. Because neither the statute nor the regulations define banking, the court was left to use the terms ordinary and common meaning. What that means is that they turned to the Webster Dictionary and looked up the term bank to find out what its ordinary layperson's definition was. And the court basically found that the Webster Dictionary defined a bank as an establishment for the custody, loan, exchange, or issuance of money for the extension of credit and for facilitating the transmission of funds. Since there was no evidence to suggest whatsoever that Party Poker and PokerStars were established for any of the purposes in the Webster's definition of bank, the court held that they weren't banks, and John's accounts with them were not reportable bank accounts. So he got a partial break here because to the extent that the IRS assessed penalties for his failure to report the bank account balances from Party Poker and PokerStars on an FBAR, those penalties were erased. He did not have to pay any penalties for them because the Ninth Circuit held that there was no obligation on John's part to report them on an FBAR. However, John wasn't as lucky when it came to the FirePay account because, once again, the court reasoned that FirePay fell within the definition of a financial institution for purposes of FBAR filing requirements because it was a money transmitter, and that there was an absolute obligation on the part of the taxpayer to have reported it on an FBAR. And the added justification was the fact that FirePay was located in and regulated by the United Kingdom, which squarely put it under the definition of a foreign financial institution. So because John never reported FirePay on an FBAR, he was liable for the tax penalties that the IRS assessed against him. And the FBAR penalties are gargantuan. I mean, it is just obscene at how much they can be. So the taxpayer got a partial break here. However, he did have to pay a substantial sum of money for his failure to report FirePay on an FBAR. If you have any further questions, about this, feel free to contact me anytime on FBAR requirements and anything relating to online poker accounts.